This could turn out to be one of the most important precious metals outlook discussions you'll hear this year. A major global bank has issued a projection that is turning heads across the investment world. A gold price target of roughly $6,300 per ounce by the end of 2026. Pause for a second and think about what that implies. With gold currently trading near the mid-$3,000 range, that forecast suggests a potential move of close to 80 to 90% from present levels within less than a year. That is not a routine adjustment. It's a bold macro call.
We are not talking about a small research shop or a social media forecaster making noise for attention. This projection comes from one of the largest and most influential banking institutions in the world, an organization that manages and advises on trillions of dollars in global assets. When a bank of that scale publishes a long-term target like this, institutional desks, fund managers, and macro analysts pay attention. These forecasts are typically backed by models that factor in interest rate paths, currency trends, inflation expectations, central bank behavior, and global liquidity conditions. At the moment, gold is trading around the low to mid $3,400 range. Silver is hovering near the low 70s, and the gold-silver ratio is sitting around the high 40s. These baseline numbers matter because they show how far prices would need to travel to reach the upper institutional targets being discussed. When you compare current pricing with projected levels above $6,000, you begin to understand why this forecast is creating such intense debate among investors. Let's set expectations clearly. This discussion is not a prediction guarantee. It is not a trading signal. It is not financial advice. The purpose here is to walk through the reasoning behind the institutional outlook, explain the drivers being cited, and outline both the upside case and the downside risks. Real analysis includes uncertainty. Anyone presenting markets as one-directional is oversimplifying reality. According to the bank's published outlook, their confidence in gold remains strong despite recent volatility. Their analysts describe an ongoing structural shift in global asset allocation, specifically a gradual move away from pure paper assets and toward tangible, real assets. In simpler language, they believe large pools of capital are increasingly looking for stores of value that are not directly tied to currency systems or debt markets. Gold historically plays that role. What makes the situation more compelling is that this bank is not standing alone. Several other major global financial institutions have also issued elevated gold targets for the 2025-2026 window. Different banks have published projections ranging from roughly $5,000 to above $6,000 per ounce. While the exact numbers vary, the directional bias is consistent: higher gold prices over the medium term. When multiple competing institutions arrive at similar directional conclusions using different models, analysts take notice. These forecasts are not appearing in a vacuum. They follow a period of extraordinary performance in the gold market. Over the past year, gold recorded dozens of new all-time highs. Average annual prices climbed sharply compared to the prior year. Total global demand reached record levels, driven by central bank purchases, investor flows, and defensive allocation strategies. Institutional forecasts are often extensions of existing momentum, combined with forward macro assumptions. One particularly interesting detail is timing. This bullish projection was reaffirmed shortly after gold experienced one of its sharpest single-day declines in decades. Instead of backing away after the drop, the institution maintained, and in some respects strengthened, its long-term bullish stance. That suggests their model interprets the sell-off as volatility within a broader uptrend, rather than a trend reversal. Large institutions often distinguish between short-term price shocks and structural directional moves. A major pillar behind the bullish thesis is monetary policy uncertainty. Markets are entering a period where central bank leadership tone, rate strategy, and balance sheet direction are all under close scrutiny. Even subtle shifts in forward guidance can move currency markets and real yields, and gold is highly sensitive to both. When real yields fall or confidence in fiat stability weakens, gold historically benefits. Another driver is sovereign behavior. Central banks around the world have been increasing their gold reserves over recent years. This is a measurable trend, not a theory. Reserve diversification away from single currency concentration has become more common,
and gold is one of the few reserve assets without counterparty risk. Continued central bank accumulation creates a steady baseline layer of demand that did not exist at the same scale decades ago. Currency dynamics also play a role. If the US dollar weakens over a sustained period, gold priced in dollars often rises mechanically. Even if gold holds constant purchasing power globally, a softer dollar can push nominal gold prices higher. Many institutional commodity models incorporate multi-currency valuation frameworks, rather than viewing gold only through a dollar lens. Now let's bring silver into the conversation because it frequently follows gold, but not in the same way. Silver is both a monetary metal and an industrial input. It is used in solar technology, electronics, medical equipment, advanced batteries, and multiple high-growth manufacturing sectors. That dual identity gives silver a hybrid demand profile. Gold demand is primarily financial and reserve-based, while silver demand is split between investment and industry. Because of that structure, silver tends to be more volatile. In strong precious metal bull phases, silver often rises faster than gold in percentage terms. In corrections, it can fall harder as well. Historically, silver behaves like a leveraged version of gold during momentum phases. That can be attractive for aggressive investors, but uncomfortable for conservative holders. Volatility cuts both ways. A commonly watched metric is the gold-silver ratio. How many ounces of silver are required to buy 1 ounce of gold? When the ratio is very high relative to history, silver is considered cheap versus gold. When it is very low, silver is considered relatively expensive. Today's ratio is below its long-term average, which suggests silver has already outperformed somewhat. But ratio signals alone are never enough for a decision. They are context tools, not triggers. Another emerging factor in the gold market is tokenization. Digital tokens backed by vaulted gold reserves are becoming more available. These products allow fractional ownership and easy transferability. They remove storage and transport friction for some investors. However, they introduce new categories of risk: issuer credibility, audit transparency, custody integrity, and regulatory exposure. Physical gold has storage costs, but no issuer risk. Tokenized gold has convenience but added counterparty layers. Each investor must weigh those trade-offs carefully. It's also essential to discuss the risks to the bullish case. Gold does not rise in a straight line. Stronger than expected economic growth can lift real interest rates, which historically pressures gold. A sustained dollar rally can reduce international gold demand. If inflation falls faster than expected, defensive asset demand can cool. Liquidity squeezes can force leveraged funds to sell gold, even if the long-term thesis remains intact. Short-term drawdowns can be severe. Silver carries additional risks because of its industrial exposure. A slowdown in manufacturing or renewable energy investment could reduce fabrication demand. Silver's thinner market depth compared to gold can also amplify price swings. Investors need to be psychologically and financially prepared for volatility if they allocate to silver. Institutional targets are scenario-based, not promises. They depend on macro variables evolving within projected ranges. If those variables shift, targets change. Large banks revise commodity outlooks frequently as data updates. Treat projections as conditional pathways, not certainties. Still, it is unusual to see such broad alignment among major banks toward higher gold prices over a similar time horizon. Institutional consensus does not guarantee correctness, but it does signal that multiple independent research teams are seeing comparable macro pressures building beneath the surface. The broader thesis many of these institutions share is that we are in a period where real assets, commodities, resource equities, and hard stores of value may outperform purely financial assets. High debt levels, persistent inflation risk, geopolitical fragmentation, and reserve diversification all support that framework. Gold sits at the center of that real asset thesis. For investors, the key question is not simply whether gold could reach a certain number. The real question is portfolio role. Is gold being held as insurance, as speculation, as currency hedge, or as diversification ballast? The answer changes position size, time horizon, and risk tolerance. So here are the core takeaways. First, Multiple major financial institutions are projecting materially higher gold prices into 2026, with top-end targets above $6,000. Second, gold and silver offer different behavior profiles. Gold tends to be steadier, silver more explosive and more volatile. Third, new access vehicles like tokenized gold increase flexibility but introduce additional risk layers. Fourth, volatility and drawdowns remain very real possibilities, even within a long-term bullish framework. We are at a fascinating moment in the metals market. Prices recently experienced historic swings, yet long-term institutional projections remain elevated. That tension between short-term turbulence and long-term optimism is exactly where major trends are decided. Do your own research. Stress test your assumptions. Size positions responsibly. Never rely on a single forecast, including this one, to make financial decisions. Independent thinking is your strongest asset in any market cycle. And I'd like to hear your view. Do you believe gold reaching above $6,000 within the next cycle is realistic, excessive, or still too conservative? Which metal interests you more going forward, gold or silver? Your perspective matters, and thoughtful debate makes everyone sharper.